Are you being pitched, this is the best annuity, especially this one is offering a huge 20% to 30% bonus with a lifetime guaranteed income, and you better buy it before the bonus goes away?
Or are you being told your lifetime income will double and that your annuity will cover long-term care too? Well, does all this sound too good to be true?
Well, in this video, we will answer the most common questions. Number one, what are the different types of annuities? Number two, how do you compare all fixed index annuities with all the lifetime income riders? It just seems so overwhelming. Should I consider an annuity with long-term care coverage? And which annuity best covers inflation? Fifth, which annuity is the best, and do I even need an income rider?
Now, pay attention to the sales pitches and the marketing gimmicks that try to convince you to buy their annuities.
And stay tuned to the end of the video where we will show you the golden formula, the secret to compare all the annuities without spending hours or days doing so. This way, you will have the confidence to know which one will provide you the best and the highest guaranteed income for life. Hi, I'm Ann.
You're Ann? Oh, wow, when did that happen? And I'm Kai.
Excuse me. Hi, I'm Kai.
And I'm Ann. And it's been a while.
Now, if you haven't done so, make sure to watch our other videos up here where the entire video explains the 5 types of annuities. Or you can click on the description below and watch after this video.
However, we will briefly touch on the 5 types here to lay the foundation for today's video, so you know which annuities are the best for you.
Let's clarify one thing first. If someone says this is the best annuity, then run away. That's like saying this car is the best car. Well, first, what type of car? Is it a sedan? Is it an SUV? Is it a truck?
Right. There's no such thing as the best annuity. You must first understand which type of annuity you want. So here it is. We have a SPIA, which is a single premium immediate annuities. Then there's the MIGA, multi-year guaranteed annuities, the VA, variable annuities, FIA, fixed indexed annuities, LIR, hybrid pension annuities. Now, an immediate annuity is the oldest type of annuity. This is exactly what a traditional employer pension is and what your Social Security is too. You annuitize your money, meaning you give a lump sum of money to the insurance company in lieu of lifetime guaranteed income. That's why they're called SPIAs, or single premium immediate annuities.
Exactly. Remember the word annuitize has a letter Z. So Z is the last letter of the alphabet. So if you annuitize your money, that's the last time you'll see your principal. So
makes sense.
Yeah. Now, correct. That's why these are not deferred annuities, since there are no cash values to defer.
And we are not fans of this type of annuity because you don't have any control over it.
Now, these single premium immediate annuities have no yearly fees associated with them. Now, there's a time and place for these annuities, of course, but in most cases, a hybrid pension is a much better option if you desire to have control over your principal.
And we'll also show you a playlist on hybrid pensions at the end of this video. Now let's briefly discuss the 4 types of deferred annuities. And by the way, all deferred annuities can be IRA or non-IRA type of money.
So what you're saying is you can transfer 401k to IRA or IRA to IRA, or use non-IRA for annuities or hybrid pension.
Correct.
That's a very key point because a lot of our clients always ask us that question. So, all right. Now, the second oldest annuity is a fixed annuity called a MIGA, M-Y-G-A, or multi-year fixed annuity. We call this a CD on steroids. So while banks offer CDs, insurance companies offer MIGAs. These offer higher interest than most CDs out there. But best of all, you never get taxed until you start taking money out. Now, we've seen our clients defer MIGAs for decades and even never use it and just pass it on to their beneficiary.
Oh yeah, and they avoid probate too.
That's right. Who doesn't want that? Now, all annuities, the good and the bad ones, just to make sure you're clear, they all avoid probate. Now, regarding fees, there are no fees with MIGAs. If you want lifetime guaranteed income, your only option is to annuitize or turn it into an immediate annuity,
which we generally do not recommend.
Right.
Now, the third type of annuity that was created is called variable annuities. The name itself gives it away. These are not fixed. Your principal will have gains and losses, and most importantly, you will have fees ranging from 2% to 5%. Again, our other videos dive deeper into all the fees associated with variable annuities. For these annuities, you can add a lifetime income rider as an option or annuitize your money. These too have a place, but in most cases, we are not fans of these annuities.
Who loves all those fees? Yeah. Now, the fourth annuity that was created in the 90s is called a fixed index annuity, or FIA. These annuities were designed as a hybrid between a fixed annuity and a variable annuity. Now, with these annuities, your money is linked to the performance of the index, but your principal is never invested in the index. It's almost like you're not surfing in the ocean, rather you're on the beach watching the surfers. So you don't buy or sell any shares. Therefore, you benefit from the upswings of the index with no downside risk. You will never lose your principal like being in a variable annuity, like being in the ocean. Basically, if the index does well, your money grows because it's linked to the index. You get the performance of the index. But if it falls, your money will not fall. Your money is protected. You don't lose your money.
And we have these videos here above Kai's head that dive deeper specifically into fixed indexed annuities and how they work. These annuities typically have 0% in fees unless you want to add a rider. Now, these annuities can also be annuitized, but are mostly sold with a lifetime income as a rider.
This brings us to our last deferred annuity, hybrid pensions. These include a deferred cash account and the concept of a SPIA, or traditional pension, put together. This traditional pension becomes a rider called a lifetime income rider. These riders can also be attached to a variable annuity or a fixed annuity. These are never offered with a MYGA. These rider fees are typically around 1% to 1.5% across all the different insurance companies. Now, there are a few plans that offer them at no charge, but we will discuss the pros and cons for these as well.
So which of these are best for you? We'd love to hear your opinion down below. Now, real quick, if you haven't done so, please click the like button and subscribe, as that really helps us grow our channel. Each video takes us hours to produce before it's released, so we really appreciate your support. And as a thank you, here's a picture of Gracie guarding all her food from her siblings. She's so possessive.
Yeah, exactly. So which of these are best for you? Well, we'll break down these annuities into two paths. Either way, do not compare them to investments. These are not investments, except for variable annuities. So if anybody ever says annuities are a horrible investment, yeah, it's kind of true, because annuities are not an investment. They're an insurance product. Either guarantees your principal or it guarantees you lifetime income. So, for example, if you ever bought a CD is also a horrible investment because it's just a fixed rate of return. It's technically not an investment. Investments, you have an opportunity to make money and also lose money. So these are all fixed. Okay, so for example, if you're looking for just a fixed rate of return like a CD, a vehicle just to protect your money with no market risk, and you want a guaranteed interest rate, well, then a MYGA is perhaps the best choice. Now, here at KCIIS, we'll shop around all the companies for the best rate for you. And if you factor the compounding rate and tax-deferred savings, you'll typically have a rate around 2% to 3% higher than a CD.
And the other path that we also don't compare to investments is a salary replacement. If you wished your job had a pension or you are looking for a guaranteed lifetime income stream, then a hybrid pension is the best. The only two choices of a hybrid pension to replace your salary would be a fixed indexed or a variable annuity. Now, it is an easy no to variable annuities. There's just too many fees associated with a VA, and your principal is still at risk.
And it's also, remember, an easy no to SPIAs. In most cases, if you buy a SPIA or an immediate annuity, you'll get the lifetime income, but you'll have no control and you can never change your mind and cash out.
Correct. Again, don't compare these to investments, just like I've never heard anyone compare their salary to their investments and say which one is better. The design of these is to replace your salary, just like why pensions were designed. But as a hybrid, you get more choices.
Exactly.
Fixed index annuities are the best option for a hybrid pension. Why are fixed index annuities the best option? Well, these have the lowest fees, typically only 0% to 1%, and no market risk at all. while guaranteeing your income for the rest of your life.
Again, don't compare these two investments, just like I've never heard anyone compare their salary to investments and say which one is better. The purpose is to give you a salary replacement.
And since most of you watching are concerned about retirement and income replacement, today we are going to focus on the differences between all the fixed indexed annuities with a lifetime income rider. And besides discussing some unique features like long-term care or inflation, let's first discuss the similarities with all of them, comparing all FIAs.
First, they all have a minimum floor, a point-to-point crediting strategy, caps and or participation rates, fees or spreads, and a choice of different indexes. Now, if this seems overwhelming, again, we'll show you a playlist at the end of the video that goes into this a bit more. Now, let's at least discuss caps and participation rates. This is how the insurance companies limit your earnings. If the index performs well, they all have either a cap or participation rate to limit what would be credited to you. So let's say your index went up 10%, and if you have a cap of 5%, well, the most you would get is obviously 5%. However, if you had a policy with no cap, and let's say you had a 50% participation rate, and the index went up 10%, well, what's half of 10%?
5%.
It's the same thing. So you need to know what are the caps and the participation rates.
Now, let's talk about riders. Most fixed index annuities have two common riders to choose from. One is an enhanced death benefit rider. This option is normally not a popular choice since this only gives a guaranteed interest for your beneficiaries. And that's why they call it an enhanced death benefit rider.
Now, I don't know about you, but I love our kids, but I want to enjoy the money while I'm alive. So the most popular rider is called the living benefit rider. Now, commonly referred to as a lifetime income rider. But we like to use the term living benefit since this is what employer plans call their pension plans. In fact, you might have heard of 401ks as a defined contribution plan, while pensions are called a DB or defined benefit plan, and you can also call them a living benefit.
You can also choose one or the other, since the two words contradict each other. You're either concerned with dying or living too long.
Pretty straightforward, right?
Right. Well, living benefit riders are what cause the most confusion. So let's dive deep into the 5 major types of income riders.
Now, there is one special exception, so make sure you stay tuned.
While we discuss these lifetime income riders, remember that these are all hybrid pensions. So the left side will represent your cash value that you still have full control over, while the right side will represent the pension or the living benefit rider.
Let's first discuss the type of lifetime income rider that has no fees. Now, before we start comparing, please be prepared to maybe slow the video down, watch it over again. We are going to go in depth, so hopefully we don't lose you. Now, the first one we're going to discuss is the type of lifetime income rider that has no fee. Not too many companies have this option, but the best part of these is that there is no fee associated with these riders. But while the rider has no fee, the cons are there's no income growth guarantee while deferring your money. There's no guaranteed calculation for your income payout. And your income calculation is 100% dependent on the cash value's growth. So in other words, you might delay, and when you delay, you're typically hoping your income is going to grow, like Social Security, right? But in this case, if your cash doesn't grow, then your income is not going to grow. Or if your cash doesn't grow much, your income is going to be much smaller than what you hope for.
Yeah, now don't expect spectacular growth on your cash value. The cash value's caps will be average, or if there is no cap, the participation rate will also be average. There's always a give and take somewhere.
Yeah, on those type of annuities, right? With those riders.
Right.
Right. Now, let's discuss the most popular type of lifetime income riders. These have the highest guaranteed growth per year if you wait or defer your income, sort of like Social Security's guaranteed growth for each year you delay.
The fees typically range from 1% to 1.5% with all insurance companies. And the good news with these income riders is that the fee is always taken from your cash value. So you never have to worry about them deducting the fee from the income you're receiving. Also, the income calculation is not dependent on the cash value's growth. In other words, your income will have a contractual guaranteed growth regardless if your cash value grows.
Yeah, and if you're worried about the cash value, we'll discuss that towards the end of this video. But the cons is that there's no inflation adjustment after you start the rider. There's no growth option at all after activating this lifetime rider.
Well, what about the lifetime income riders that do have the inflation adjustment option? This now brings us to the third type of lifetime income riders, inflation adjusted with the Consumer Price Index or CPI. Again, the fee for these riders costs around 1 to 1.5%. But again, the fee is taken from the cash value and never lowers your income.
And this income calculation also is not dependent on the cash value's growth, just like the one we discussed earlier, since these riders sometimes come as an option with a flat and level income payout that we just discussed.
So the main benefit is that the income grows with the CPI even after you start the rider. Sounds great, right? Well, the con is the income starts at an average of 30% less than the flat and level.
Yikes, that's a big drop. Again, there's a give and take. Your cash values cap will also have a lower cap, and your participation rate is going to be just only average.
Because the CPI adjusted income riders lowered the income so much, some insurance companies came up with the idea to have your income go up based on the index gain. So the fourth type of income rider is called index gain adjusted riders. The pros with these riders are, again, the fee is taken from the cash value, so it does not affect your income. The income grows with the index even after you start the rider. However, the cons are the income starts at an average of 20% less than the flat and level.
Right. So even though it still grows, like Anne mentioned, after you start the index, you have to be prepared that your income is going to start much lower.
Right.
Okay. So while the payout is higher than the CPI index inflation option, your income calculation is dependent on the cash value's growth. It is dependent on the cash account's point-to-point credit. What this means is your income may not grow if you have no gain from the index. Your cash value's cap will have a lower cap, and your participation rate is only going to be average.
Right. So next, let's talk about this controversial nursing home doubler rider.
Oh, yeah. Everybody asks that question.
What is this rider? Well, what this rider does is it doubles your lifetime income for 5 years.
Only 5 years, though.
Only 5 years. But wow, why wouldn't everyone buy this, right? Especially if it comes part of the whole package. Well, the biggest disadvantage is these riders are usually not sold correctly. Clients are often misled thinking this is a long-term care coverage. This is not long-term care coverage. While this option might be better than not having any coverage, no one should sell this as a long-term care package or tell you you don't need long-term care just because you have this doubler.
Another disadvantage is that in most policies, you must be confined to a nursing home or a hospital and cannot perform 2 activities of daily living. So if you're at home or in an assisted living, your income will not double, and having the nursing home doubler rider would just be a waste of your time and money.
Right. And only 4% of us will ever need to go into a nursing home, while 66% of us will need some type of home or assisted living care.
Right.
Another reason this should not replace a long-term care policy is that a requirement for the doubler to be activated and stay activated is that you must have money in your cash value. Well, when do most of us need long-term care? It's in our mid-80s.
Right. So you may not have the cash value left. Well, the insurance companies know that if they offer you this doubler, they know that most likely you won't have much cash left in your late 80s. So what they're going to do too is going to offer you a lower cap, or the participation rate is just going to be average, hoping that you most likely won't have any cash left in your 80s. So this is the reason why many states do not allow this rider. It's not marketed correctly and often very misleading.
Yeah. Your cash values cap will have a lower to lowest cap compared to the competition, and your participation rate is going to be only average. Well, remember when we mentioned in our other video that we represent over 50 plans and we can assist in all 50 states? Well, as an independent agency, we are going to discuss a special rider that most people who call us have never heard about. What's the exception to the 5 we just mentioned?
It's the flat and level, the highest income with a DAV, not daily average value, daily accumulation value. Now, this was made by a group of third-party engineers that sold this one model to a huge insurance company. Now, we won't name the insurance company for compliance reasons, and we don't know how long they'll offer this from the time that we shoot this video. But like all other models that we discuss, the fee is taken from the cash value. It does not lower your income. The fee is also on the lower end of only 1.1% currently. And just like the flat and level, the income calculation, like I said, is not dependent on the cash value's growth.
So here's a distinction. The income calculation is the greater of either 1, the minimum income growth, or 2, the highest daily accumulation value, the DAV.
Right. This is not, again, like I mentioned, daily average. This is the daily accumulation. And if you notice what Anne said, the highest DAV or the highest daily accumulation value. So it's automatically locking in your cash values growth, or it takes a picture of your cash values growth, and whatever the highest day is, it will replace the minimum formula. I know it sounds confusing, so call us and we'll explain more. Now, because there are 365 days in a year, the highest DAV gives you 365 potential daily high points. The highest daily value is not dependent on the cash values point to point, which means your income has more potential for growth, 365 times. Now, there's also icing on the cake here. Now, like the CPI and the index gain adjustment options that continues to grow even after you start your income, the highest DAV will continue even after you start your income.
However, this is not a fit for everyone.
Right.
Why? The cons are there is no CPI inflation adjustment option, no nursing home doubler option, and lastly, we can usually shop around and get you a couple companies that might pay slightly higher than this model. Now, we're not talking about a huge difference since this model is generally still number 3 compared to the competition.
Right. Now, another distinction is the cash values participation. This is what really sets them apart. They have no cap option, so no cap, you cannot choose a cap option, which is good. And they have both a 1-year and a 3-year point-to-point strategy. Again, if you don't know what that is, you can watch our playlist where we're going to the point-to-point. Now, their 3-year point-to-point currently is averaging over 200 to over 300% participation, depending on the state that you live in. Now, for some of you skeptics, how can you get more than 100%? Remember, you're not in the market. You're getting a participation, or you're getting a percentage based on the performance of the index. So think about when you were in school. Did you ever get extra credit based on your performance? Right? So we're not in the market. If you're in the market, you cannot get more than 100%. You're getting 100% gain and you get 100% loss. So here, we're not in the market. We're just watching the index, and we're watching the performance of the index, and then the insurance company gives you credit based on the participation percentage. So again, I know it's confusing, but call us and we'll give you the current rates and to see if this model is still available in your state and which one is the best for you.
So which hybrid pension is the best? Well, here at KCIIS, we don't believe that there is a best overall. There's only the best for you individually. Right. Just like buying a car, some might want and need certain features, while others could care less.
Yeah, like a sports car. Thanks, honey.
Exactly.
Okay, so let's review these options we discussed and figure out which option might be best for you. First, if the highest guaranteed income is most important, then choose a level, flat and level, the one with the highest guaranteed income. You can predict your retirement, you know exactly what you're gonna get. Again, the participation rates will be just average, but you must be okay that there's no future growth after you start your income. And you also must be prepared that your legacy or cash value has the highest chance of being depleted. So real quick, if you don't have kids, that might be a good option for you.
Now, if a high income guaranteed growth along with future growth is the most important, then choose the flat and level with the DAV. You'll have very high income, guaranteed income, or the highest DAV. The participation rates are very high, if not the highest in the industry, and you can expect your legacy or cash value to have a smaller chance of being depleted.
Right, so this is for someone that wants the highest, well, one of the highest, maybe not the highest, but has potential growth for potential growth of income, and you're really concerned about that legacy or cash value. Yes. Okay, so what if you don't mind your income to have no guaranteed income growth while you're delaying? Well, this will be the no fee option. See, these no fee income riders are designed for people that don't want to pay a fee. They don't mind guessing what the income was going to be. And you can also expect the participation rates to be just average. Now, even though the par rates, participation, are just average, because there's no fee and your income is smaller compared to the other two that we just discussed, your legacy or cash value will also have a smaller chance of being depleted.
Now, we want to caution you on these following lifetime income riders. The nursing home doubler, if available in your state. The participation rates are okay, but not the best. And you may not have cash value in your 80s, which means the rider will not double as you hoped.
And again, we're not against that.
Right.
Just make sure you know what you're getting before you buy it, because we do offer them. Okay, we also caution you on the CPI and the index growth inflation adjustment riders. Your income starts much lower and the break-even point might be too long.
And we do ladder most of our clients' policies to help keep up with inflation.
Now, besides the different types of income riders, remember the following points that should be on your checklist for your cash value. What should you look for? High caps or high participation rates with no cap. A good reputation of good rate renewals, meaning they don't play games with the caps and participation rates. The good companies, like all good insurance companies, will keep things consistent. Now, of course, there are more bad companies than good, so give us a call and we can show you the ones with the best reputation.
Remember, though, your lifetime income with most of the riders we discussed are not dependent on these rate renewals. Your guaranteed income grows independently with the flat and level type riders.
Lastly, you'll want high-performing indexes, low fees or spreads, in some cases, no fees or spreads, and you want to have a high rating. Now, we usually go for A- or higher in most cases.
Yes. Now, we know this video has a lot of information, but after all, this is your life savings we're talking about. So we recommend to rewatch this video and call us to go over this information with you. Okay, so what's the secret in choosing the best, highest guaranteed income payout? Well, click here for the golden formula in getting the best, highest payout without spending hours comparing them.
And if you're new to the hybrid pensions, make sure that you watch our entire hybrid pension playlist here, where we'll explain in detail what they are and if having one for you is the right choice.